this question, though, about whether you're seeing pushback or not. It's kind of conflicting when we look at the data. Yeah, retail sales were weaker than expected, but the fact that we got 2 hotter than expected inflation prints, the fact that Coca-Cola said that they could increase their prices by 9%, the fact that you're seeing this pretty consistently speaks to a different narrative.
Well, when these companies say that they can increase prices, they can, but that's at the expense of volume. So, you can raise your prices all you want, but the question is, will consumers actually buy it? And that's where, we think that we're going to see an uptick in promotional activity this year, just because they're going to need to incite consumers into purchasing greater volumes. So there's going to be a shift in the balance. The last few years, it was all about growing the top line. Inflation helped support that. Now we're looking at a very different kind of story for these companies.
Yeah, I mean, we face the supply chain challenges. What they've got now, of course, is higher wage bills on the reporting side. I'm curious to get your view on this. We'll come back to the price rises at the moment. Who's got the capacity actually to hold? It's the higher end of the market where that seems to be resilient. But talk me through wages. And if all the supply disruptions are really all gone, I'm talking to sort of big industrial companies, and they're saying they still have supply challenges. So wages first.
Well, when you talk about wages, and again, thinking more about the consumer packaged companies, a lot of these companies, it's unionized. And so once labor contracts are negotiated, they're not going to go back down. They're only ever going to go up. And, as coming out of the pandemic, there were a lot of negotiations with regards to the working conditions and the salaries and things like that. When it comes to the consumer, wage growth has slowed a little in relative to inflation, at least, and so consumers are still in that spot where they're making selective decisions when they're purchasing, even on everyday essentials. So it's a unique situation where labor, depending on which side you're on, is an issue.
Do you think companies the ones that had to do all of these higher wages because of unions, I think of UPS, but then had to lay off people, are going to have to make up with some of these wage gains with laying off other parts of their business?
Well, at least in my industries that I cover, they went through some large layoffs not that long before the pandemic. And so they are relatively lean at this point, but there will be a focus on cost cutting. Most of the time, that's going to be on internal things. And for the next year or two, the low-hanging fruit is really in bringing costs out of the supply chain. During the pandemic, because there was such an emphasis on just getting goods to be available for people, it added a lot of cost into supply chains across the board. So the low-hanging fruit for this year and maybe a little bit into 2025 is how do you right-size your supply chain again and take the costs back out? That should help eliminate the need to do any kind of mass layoffs.
Jennifer Potashis of Bloomberg Intelligence. I'm sure we'll be catching up with you next week when we get Walmart and Home Depot earnings. Thank you for being with us today. If you are just joining us, just to recap what we just saw, inflation data coming in yet again hotter than expected. And this data goes directly into the Fed's core PCE deflator that they look at to really gauge out where inflation is. The response in markets has been the knee-jerk decline in bonds, the decline in stocks, decline of 0.2%. Not a lot of drama. We don't want to overstate it necessarily. In the S&P 5,037. The Russell 2000, though, Manus, really taking a hit as it has been the hardest impacted by any potential increase in rates implied over the rest of this year.
Yeah, it's the torture of the value to growth proposition and the going for breadth. 10 basis points on 2-year notes. We're trading at 467. I think you had the start of the day, that's the highest so far this year. If you look at 10s, 430. Again, trapped in the upper echelons of this bandwidth between 375 and 430. And the natural question is, do you look at this as an opportunity to step in for duration, or do you run the risk that this is going to be a very stumbling, difficult road back to a more normal, the norm of inflation that the Fed want to see?
Inflation is highly political. And Anne-Marie, I'm sure we'll hear a lot of discussions about how the inflation genie hasn't gotten fully into the bottle and concerns from the political sphere. How do you message something as noisy and messy as disinflation?
It's very challenging for this administration. You see them try to say, look where we were during the depths of the pandemic and look where we are now. They're not going to want to focus on any specific report that we get. But obviously, when the economic data is noisy and the American people aren't feeling it, it's very hard to message that. So you've seen the administration go after corporations about greed, shrinkflation, but today, the Michigan survey. They have really been harping on this because the past two, the survey has been much better, and they're hoping that the American people are starting to feel some of the good data.
That's in part what they're banking on, isn't it? That whole sentiment.